Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. And today we talk about investing for high net worth individuals and how mutual funds help this category, the high risk category it is, to minimize risk and maximize returns at the same time. We'll also talk about how the investment allocation is different from those of retail investors with our guests today, Varun Fatehpuria, who's the founder and CEO at Daulat Finvest, and Nisreen Mamaji, the founder at MoneyWorks Financial Services. Nisreen and Varun, thank you so much for joining in on the show today. It's a very interesting topic, so good to get your opinion on the same. Lady, let me start with you, because we need to understand with the basics. What are some of the characteristics of HNI or maybe ultra HNI portfolios? How are they different to, say, regular retail portfolios?
Sure. So thank you so much for having me on the show. Let me start with that, and I'll dive straight into the topic. So basically, between ultra HNIs and HNIs, the portfolios will typically vary between size, complexity, and customization. So for a high net worth individual, they have more alternative assets. So they'll have hedge funds, private equity, a wider range of investments, and a higher risk tolerance. So they might also include, a global diversification, highly customized techniques, and exclusive investment options such as direct business investments also, which are all common features for high net worth and ultra HNI investors. In contrast, retail investors are more conventional, will possibly be a little more passive, and are frequently restricted to publicly traded stocks, bonds, and mutual funds. So they will concentrate more on asset preservation, tax optimization, and estate planning, so to speak. So an ultra high net worth and high net worth individual would probably have a higher risk tolerance and, would be able to accept the volatility of equity markets much more. So in a nutshell, this is the difference between what a retail investor would be looking for and an HNI or ultra HNI investor.
Okay, we take that point. Varun, anything you would like to add to that, what Nisreen said?
No, I think Nisreen summed it up really nicely. But I think one of the things that we have observed when we go speak to HNIs, UHNIs, is obviously the ability to take on a higher amount of risk compared to regular retail portfolios, due to which they can create very tailored strategies for each of the financial goals that they have. Right? If we take, for example, a regular retail portfolio, most of them, and that's also reflected in the flows that we see in mutual funds, are geared towards long-term wealth creation, and that's why you see a higher retail participation in equities. But for an HNI, UHNI portfolios, just by the virtue of having a higher investable asset, they can create very tailored strategies for each of the financial goals for, let's say, wealth preservation, for income generation, for longer-term wealth creation, because of the number of instruments that are available to them. So not just mutual funds, but also PMSs, AIFs, unlisted equities, real estate.
Okay, take that point. So it's a diversified portfolio with a lot of high-risk assets as well. So in that case, Nisreen, what would the role of mutual funds be in ultra HNI portfolios?
So the mutual funds play the same role for the retail investors as well as the UHNI and the HNI investors, in the sense they give them diversification, liquidity, and professionally managed exposure to the various asset classes. So they also complement direct equity, the PMS and the AIF portfolio with which an HNI or an UHNI investor will typically have. So by offering an access to high-performing equity funds, debt funds, and hybrid funds which are tailor-made, for market conditions. So, for example, a focus mutual fund, as a category, would very well suit and complement the PMS and AIF investment which a HNI investor would already have. So, typically, also for the shorter-term liquidity requirements, mutual funds play a very good role for HNI investor. Say a debt fund, a balanced advantage category, a hybrid fund. So, even if you're managing a family office, it would be, in tranches in terms of time. So it would be, you'll be managing a 1-year portfolio, a 1 to 3 year portfolio, and then, longer and so on and so forth. So especially for the 1 to 3 year time frame, the mutual funds play a very active role because the cash management for HNIs and for a family office investor is very well managed by a hybrid equity fund or, the balanced advantage category, or even in some cases, debt funds. So typically an HNI portfolio would be having, also illiquid investments like real estate or private equity or direct business. So those are the ones that you can't really manage for cash flow. So mutual funds actually play a very, active role and a very valid role in an HNI portfolio also because of these reasons mentioned earlier, and also for accessing cash and reallocating funds without having to liquidate, illiquid kind of strategies. So that's where the mutual fund portfolio would have a very, very important role for an HNI investor.
Got it. Varun, coming on this, it's the same. Of course, mutual funds would play largely the same role. But when we talk about the overall portfolio construction, there are other assets as well. As you pointed out earlier, there is real estate. You would have high risky assets as well. So does it balance the overall return profile for ultra HNIs?
Absolutely, Sonal. I think one of the noticeable shifts that we are seeing in our conversations with HNIs, UHNIs over the last few years is obviously this notion that they want to increase that allocation to mutual funds over the last few years. I think previously there was this concept of, gravitating towards only PMSs and AIFs because you have a certain amount of investable asset. But now increasingly we are seeing that HNIs actually want mutual funds to form a core of their overall allocation, simply because these are well-regulated products, easy to understand, simple in nature, and low cost compared to, let's say, other higher, riskier assets with the kind of lock-ins that they come into the picture. So definitely, I think all of those asset classes complement mutual funds from an overall asset allocation perspective. But we are seeing an increasing shift where HNIs are warming up to this idea that they want to increase that allocation to mutual funds due to the advantages that I just mentioned.
Okay. So, Varun, coming back to you yourself, when managing money for Indian HNIs, how much of the money is invested via mutual funds? Is there some data available there?
So I wouldn't say there is a hard and fast data, but I think there was this recent study which was conducted by one of the alternate asset managers, and they were trying to plot out the kind of allocation which, let's say, HNIs, UHNIs, or even family offices would have. And it really depends on the kind of financial goals that each of the individuals or the family offices would have. But if you're looking at, let's say, across the spectrum, it could range anywhere between 20-25% all the way to about 50 to 60% due to it being highly liquid in nature. Again, the kind of benefits that we see in mutual funds. So it's really a spectrum, Sonal, from about 20-25% all the way to about 55-60%.
Okay, that's an interesting number. Actually, I didn't expect it to be that high as well, 55 to 60%. But as you said, liquid assets, so it gives more comfort to even HNIs and ultra HNIs to put in money there. Nisreen, there are mutual funds that have been able to make big money, comparable to, say, PMSs. Is there a portion of HNI wealth you would suggest putting into mutual funds, or the current number, as Varun mentioned, anywhere between 25 to 30, 55 to 60 is the standard?
So typically, depending on the, conservative or the higher risk tolerance of the investor, I think that we can put it around 30 to 50% of HNI wealth, which would be allocated to mutual funds, depending, on the risk profile and the financial goals itself. So typically, and the liquidity constraints, so those are the very key factors that one has to plan for while investing in mutual funds. Because in terms of tax efficiency or any of the other, goalposts, both of them would be slightly similar. Of course, in a PMS or an AIF portfolio, it would be higher risk, higher return. So the risk tolerance would be, paramount, as well as the time or the tenure that you spend with that kind of an investment. Because an HNI typically would not be looking at, the PMS AIF part for the cash flow management. So they have the wherewithal to stay invested in case there's a correction. So the mutual fund part of the portfolio, which could be around 30 to 50%, would be the one which, you look for your liquidity and your cash flow management. Having said that, mutual funds offer professional management, diversification, and an access to the, the high performing equity and debt segments, which are quite comparable to PMS as well. So HNIs can benefit from investing in large cap, flexi cap, focused sectoral funds also, and thereby manage, their requirement, because also, you don't want to have stock duplication in an equity portfolio with what you already have with PMS and AIF. So you have to keep that in mind, that you want to create a very diversified portfolio between the mutual funds, PMS, AIF, and of course, illiquid portfolio like real estate or collectibles and art, because that would typically also form part of a high net worth or a HNI investor. So you have to keep all this in mind. And mutual funds, I think around 30 to 50%, depending on the risk tolerance and the tenure that you're looking at and you're planning for. So those are the couple of ways that we can manage mutual funds in an HNI portfolio.
Got it. All right. We take that point. Have to get into a quick commercial break. On the other side, we'll continue our discussion with Varun Fatehpuria and Nisreen Mamaji on HNI investing when it comes to mutual funds. Stay tuned. Welcome back. You're still tuned into MF Corner. We still have with us Varun Fatehpuria and Nisreen Mamaji, and we are talking everything about mutual fund investing in the HNI category. Varun, let me start with you this time, because SEBI now is looking at a new high-risk category of mutual funds that will fit somewhere between a mutual fund and a PMS. Do you think a space like this could get HNI interest?
Sonal, I think it's important that today investors, whether we are talking about retail investors or HNIs, UHNIs, ask this question to themselves, that where does this particular product, and I'm not just talking about, let's say, the new asset class, but any investment product in general, fit into their portfolio. And as investors have become more mature and educated over the last few years, I think this is something that they're increasingly asking themselves, that is there a fit for their that particular product into their portfolio, or is it simply mimicking strategies that I could very well find in existing products, right? So the new asset class that we are talking about, yes, definitely, I think from a product point of view, from a strategy point of view, is looking to do something different, provide investors with opportunities which today are not available in the mutual fund or the PMS space, like something like an inverse ETF, which has a negative correlation with the market, or a long short fund, which is typically available just in the AIF categories. So there are definitely interesting opportunities and avenues which this new asset class will bring into the market. And it is for the HNIs and for the investors in general to see what their portfolio construct is today, and how does this product fit in from a risk profiling perspective, from a return perspective, from a liquidity perspective. I think these are the questions that investors need to ask before they consider whether they need to invest in this new asset class or not. But just generally, to your point, definitely we think there is a lot of potential given what's out there and the consultation paper that SEBI has released. And HNIs could definitely start with smaller sums of money, become comfortable with such a strategy, and hopefully over a period of time, if they see a fit in their portfolio, definitely we can see a gradual adoption of such an asset class.
Yeah, there have been a lot of discussions around this new asset class, right? And we need more details as well on this one. So we'll, of course, get to know in some time. But Nisreen, where is the HNI money currently invested in India? What pockets is it concentrated in? Do they like a particular asset? We spoke about some illiquid assets as well that they like. If you would like to elaborate more on that, I know you've spoken about it earlier.
So in India, typically, the HNI investments are primarily concentrated in equity markets, alternative investments, and real estate. Within equities, they typically favor the blue chip stocks and sectoral opportunities like IT, banking, pharmaceuticals. They also invest in emerging pockets like electric vehicles, renewable energy. So there are certain of these particular sectors that they take a lot of active interest in. Beyond equities, HNIs allocate funds to the alternative investments, the AIF category, PMS, obviously, and debt investments for diversification. So private equity, unlisted companies, startups, these are the places which are growing areas of interest for HNI investors. Additionally, HNI investments in real estate focus on premium residential portfolios and commercial spaces in metro cities like Bombay, Singapore, Bangalore, Delhi, NCR, etc. So the InvITs, REITs, these are the places and these are the investment products that very much interest high net worth individual. So this, in short, is where the HNI and UHNI investor would take interest in.
All right. So Varun, within small and micro stocks, do preferential issues and equity warrant take most of the HNI money? Of course, it's equities, but let's talk about the micro industry as well. Since only 25% needs to be paid upfront, right?
Yes, no, absolutely. I mean, everyone today wants to latch on to small caps, micro caps, right? HNI is being no exception. And especially, I think, after the spectacular bull run that we have seen after COVID, right? Even the numbers that we are seeing today released by AMFI, where about large cap inflows have actually declined, but the mid cap and the small cap category actually continues to shine, right? But just to your broader point, yes, I think there are pockets there in the small cap and micro cap space where HNIs, UHNIs typically have found a lot of interest. It allows them basically to participate in the upside while limiting the downside to only 25%, since that has to be paid upfront and the remaining sort of can be staggered over the next 12 to 18 months. So it allows them to basically participate in the kind of upside in the small cap and the micro cap space. But yes, generally, I think it depends from individuals as well. But definitely, the strong participation has come in from the HNIs in that category due to this.
Okay. So, Nisreen, due to the large amount of money, HNI investing is not only about maximizing returns, but of course also minimizing potential risks as well, right? What, according to you, are the best ways to do this and to protect the downside as well?
So typically, in order to maximize the returns and to minimize the risk, because both of these are very important goals for, any investor, including obviously an HNI investor, you would adopt a strategy like diversification across various asset classes, including equities, debt, and real estate and alternative investments. So also, hybrid products. So AIF, PMS obviously also play a role, but, you also have to manage the risk and also the tenure. So both these are very important factors while creating a portfolio for an ultra HNI investor or an HNI investor, is to make sure that you have had this conversation, very deep conversation with the investor to make sure that the risk tolerance has been gauged correctly by the planner. Because sometimes, you might say something, but your demographics and, and your lifestyle will prove a completely different situation. So those conversations between the planner and the investor is very important initially while onboarding an HNI investor. Once you've got that right, then the recipe will, continue and work out for itself, where you can allocate towards, slightly longer products with higher risk and slightly shorter term products with lower risk. So that is the, most important, analysis that the planner would have to do while planning for an HNI.
Take that point. I have a lot more questions for the two of you. It was a very interesting discussion, but completely out of time right now. So thank you so much for joining in with your views and your insights as well. Okay, all right. That's all we have on MF Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.